this is John Baturov here with HYS Tax and Accounting Firm. In this video, I'm going to show you the difference between a Roth IRA and a traditional IRA. Very, very important when it comes to tax strategy. IRA stands for Individual Retirement Account. The government wants to incentivize individuals to save for retirement. Very, very important when it comes to tax strategy. Now, in this video, I'm going to show you two different types of IRA. There's a Roth IRA and traditional IRA. Now, they're two different types of IRA, but they're all going the same goal, right? They're all in order to incentivize individuals to save money for retirement. Now, what is the Roth IRA? Roth IRA is after-tax contributions. What that means is you make money, right? You pay the tax, and then you can make the contribution, right? Which means is there are no deductions when you put money into a Roth IRA. So if you put money into a Roth IRA, you won't get a deduction. Number three, distributions are tax-free. Since you paid taxes on that money that you made, right, the distributions are tax-free. So when the Roth IRA later on is going to pay you, right, the distributions are tax-free. Very, very cool. You can put money into a self-directed Roth IRA. You can put, and the money can grow, and the distribution is tax-free. You can even put real estate onto a self-directed IRA, right, and it'll be and the distributions will be tax-free. Very, very cool. It can literally save you thousands and thousands of dollars. That's why it's very important to go to an accountant who understands strategy. Like this, you won't have to pay heavy amounts in taxes. Now, maybe in the next video, I'm going to explain to you which ones to choose, the Roth IRA, traditional IRA, which ones can be right for you depending on certain situations. Now, number four, after 5 years, right, you can take money out of the Roth IRA as long as the Roth IRA account is 5 years old and you're over the age of 59. So let's say you were 58 years old and you opened up a Roth IRA, you have to wait 5 years. It's not enough that you're over the age of 59 and a half. Now, there are no mandatory distributions. So later on, the government wants to start pulling money out. Let's say for a traditional IRA, the government wants you to start pulling money out when you're 72. You don't have that problem with the Roth IRA. There are no mandatory distributions. Now, with the traditional IRA, it's pre-tax calculation contributions. What that means is that I make money, right? I put money into the traditional IRA, and then I pay the tax. Now it's tax deductible, right? So if I put in 2019 it was $6,000, I can deduct $6,000 off my tax return just by putting money into an IRA. It's my money again, right? And I'm going to be using that money later on in life, right? And I get a deduction. Now, if you're 50 or over, you get there's a catch-up contributions, right? Instead of $6,000, you can contribute $7,000. Now, the distributions are taxable as opposed to the Roth IRA, where the distributions are tax-free. By traditional IRA, the distributions are taxable, so you'll pay tax later on when you start pulling money out of that IRA. Now, when can you start pulling money out of the IRA? When you're over 59 and a half. Number five, right, there's a required minimum distributions. What that means is once you hit 72, the government doesn't like that you're holding money into that account. The government wants to start pulling money out of that IRA. Now, as I said before, the IRAs are very, very important when it comes to tax strategy. Guys, this is your money, this is your retirement. You don't want to be stuck later on in life. You can start putting money in slowly, and sometimes the distributions can be tax-free, and sometimes you get a deduction. Very, very cool. There's a lot of strategies you can use regarding the IRA. If you have any other questions regarding the IRA, give us a call, HYS Tax and Accounting Firm, 347-589-2822. That's again 347-589-2822. Thank you guys, stay safe, and have a wonderful day.